Hi there, welcome to Kneppy Invest. As a stock picker, I want to be able to check to see if any of my strategies hold true to my ultimate end goal. And that end goal is to beat the market returns quite significantly. In fact, I prefer to double the market returns over the long term, because if I can't beat the market returns, I might as well just put my money into an ETF and just be satisfied with being average. So I do like to go back in time and just check to see whether any sort of strategy can beat the market over the long term. And in this video, what I'm going to do is I am going to check the performance of a stock picker, and I thought I'd start with the Motley Fool, because the Motley Fool can be quite divisive among a lot of investors. Some investors absolutely love the Motley Fool, some investors hate them. In my opinion, I do find the Motley Fool to be a good source of ideas. So that's the way I look at Motley Fool. They are an idea generation machine, particularly because the amount of articles they do release on a daily basis is quite significant, and I have no doubt that is part of their strategy to release a plethora of articles. And on occasion, I do go through what they release, the articles they do release. And on occasion, quite rarely though, I do find ideas within those articles. So I found one article from the start of 2017, which was all about the top 10 buys of 2017. I just wanted to see how those companies performed over the past 5 years, because we are almost at the 5-year anniversary of that article. This is the article from the Motley Fool titled 10 Top Shares to Buy in 2017, written from Tom Richardson, published on the 3rd of January 2017 at 11:56 a.m. Now, I'm not sure if this was Tom Richardson's top 10 ideas or if this was ideas from a group of the Motley Fool writers, because there was no actual mention in the article how these top 10 ideas were generated. So this is either a test of the Motley Fool or a test of Tom Richardson as a stock picker. So let's get stuck into it. But before we look at the top 10 shares to buy in 2017, how are we going to judge the performance of these 10 companies? I'm going to compare the performance of these 10 companies. In fact, it's only going to be 9. I'll talk about why it's only 9 in a second. I'm going to compare to the performance against the STW, which is an ETF that tracks the ASX top 200 companies. And the reason I'm doing this instead of tracking against an index is because the STW also includes distributions or dividends. And that's a big part. Among a lot of companies on the ASX, you will get a fair bit of dividends. So with the STW, on the 3rd of January, the share price for this ETF was $52.97. Now, I'm going to track it over a 4-year and 10-month period, finishing on the 3rd of November 2021. I might do this video again on the 3rd of January 2022 at the 5-year anniversary. But on the 3rd of November 2021, the share price of this ETF was $68.51. That's a nice capital gain of about 29%. But also, to find the total gains, you have to include the distributions, which is what the ETFs give back to the shareholders. And over that period of time, since the 3rd of January 2017, the distributions totaled $11.12. So total gains for the STW is $26.66, or a 50.3% gain. That's sort of average, or what you should expect for an ETF that's tracking the overall market, a 50% gain over about a 5-year period. So this is actual to expectations. Now, as I compare these 9 companies to the STW, what I want to see is significant outperformance to the STW, preferably double the performance. So I want to see some of these companies, hopefully a majority of these companies, have total gains in excess of 100% over the past 4 years and 10 months. The 10 companies chosen for this article as the 10 top companies to buy include JB Hi-Fi, ARB, M&F Group, Commonwealth Bank. Now, TPG was included. Now, TPG did go through a bit of restructuring. They're now, even though they're still called TPG, they did go change from TPG to TPM. They sold off something which became TUA, T-U-A. And unfortunately, I found it really hard to get any share price information back in 2017, even dividend information. So I've decided to just scrub them from this video. Seek, Cochlear, realestatecom, Magellan, and Reliance Worldwide Corporation. As I have a look at these 9 companies that I'll be looking at in this video, this was a really good selection of companies. The only one I probably would have a problem with is the Commonwealth Bank, simply because I don't see much growth in the banks. In fact, I don't consider the banks to be long-term buy and holds. I consider them only to be buys when the value looks really good. But otherwise, a lot of these companies I would expect to perform quite well over a 5-year period, particularly over the last 5 years. So let's get stuck into it and look at the first company that was featured in that article, and that company is JB Hi-Fi. JB Hi-Fi has done quite well over the past 5 years. In fact, the share price has increased from $27.94 to $50.30. That's an 80% capital gain in those 5-year periods. Once we include dividends, which total $8.68, that means the total gain over the past 4 years and 10 months is $31.04, or 111%. So it seems like JB Hi-Fi is, or was, most definitely an investable company over this time period. Now, if you do look at the chart since January 2017, you'll see there are periods of time, particularly long periods of time, when the share price does nothing. In particular, over the first 2 years between the start of 2017, start of 2019, share price actually went sideways or even a little bit down. In fact, the share price almost hit $20 at the start of 2019. But 2019 was a really good year for JB Hi-Fi. We saw the share price of this company go from $20 all the way up to $43. And this is what you occasionally see with companies. You see long periods of time where the share price does nothing, and then 1 year, just at random, the share price does go through the roof. And I think this is why long-term buy and hold strategies do outperform most other investing strategies, because you do take advantage of those periods of time where the share price can increase by a fair bit. You might still be holding these companies during those time periods when they're doing nothing, but research has shown that this strategy outperforms all other strategies. So this company is or has been an investable company over the past 5 years. So this was a good pick. Next company chosen was Cochlear, and this seems like another success story. Share price has almost doubled, increased from $122.83 to $227.66. That's an 85% capital gain. But when you include the dividends of $13.15, the total gain is just under $118, which is an increase of 96%. We'll give this a pass mark, a good investable company, simply because even though it's not technically double the STW returns, 96% is a good return over a 5-year period. And when you look at the chart, the share price has been going from the bottom left to the top right. This is what you want to see for an investable company, a growing company. So definitely Cochlear has been an investable company over the past 5 years. Another good pick by Tom Richardson. Now to what I would consider the most questionable pick among these 9 companies, and that is the Commonwealth Bank. Again, I'd like to just to say, for my investing strategies, the banks are not long-term buy and holds. They are just short-term holds when the value looks quite good. Commonwealth Bank's share price has increased over the past 5 years from $82.40 to current share price of $107. And I think the only reason it's increased by 30% has been because the share price has gone on a bit of a run over the past few months. Well, not a few months, about 6 to 9 months. And the share price right now, I do think, is quite overvalued for a bank that won't be growing all that much over the next few years. So the capital gain has been 30%, but the banks are notorious for being nice and giving to the shareholders. dividends of $19.39, which is almost the same as a capital gain. So when you add the capital gain and dividends together, total gains are $42.99, or 53%, which is about the STW. And this makes sense because the banks hold or make up a large portion of the STW, or the ASX 200. So the STW will track close to the performance of the bank. So I did expect the Commonwealth Bank to probably track a little bit higher than the STW, not only 3% higher, because it is the best of the banks, and typically it does outperform the performance of the other banks. But again, I don't think these sort of companies have any place in my own investing strategies in regards to long-term buy and hold. I only look to take positions in the banks when I see some good value. For instance, if the Commonwealth Bank share price went down to like $50, I would think of taking a position at that point in time, not when the share price is at $107. A lot more downside, or possible downside, than upside from here on in. Next company we want to look at is ARB, and this is the tale of almost two halves. In fact, the ARB share price from the start of 2017 to the start of 2020 did absolutely nothing, just going sideways. And then from the depths of the COVID-19 financial panic, when the share price of this company almost got down to $10, we've just seen the share price and the valuation of this company just really take off. And current share price is $52, around there anyway. So share price has almost increased fivefold over the last 2 years. I'm not sure why. I'm not going to see this. We're not going to see this company explode in the amount of customers it will see. I just think there's a lot of hype, too much hype in this company right now. And we can see that in, say, for instance, the P ratio, price to sales ratio, price operating cash flow. They're all well above the historical highs for this company. But in saying all that, the performance of this company in terms of share price has been phenomenal. So if we go back to 2017, this was a stellar pick. In fact, when we get to the end, we might see this being the best pick among these 9 companies. Share price in 2017, $17.20. That's almost tripled to $50.41 on the 3rd of November 2021. So that's a capital gain of 193%, or nearly a triple in the share price. They're also given $2.18 of dividends. So that means total gains are over 200% right now at 206%. So definitely an investable company, a long-term buy and hold. The only thing I'm worried about right now with this company is just the massive increase in share price over the past 2 years. I do think the share price needs to take a bit of a breather so the financial state of the company can catch up to the multiple expansion we have seen with this company over the last 2 years. SEEK is another pretty good pick by Tom Richardson, or the Motley Fool. Share price has increased from $15.04 to $33.50, capital gain of 123%. And when you include the dividends of $1.89, total gains have been 135%. So a great pick over the past 5 years. Really good returns, double the market returns at 135%. One thing I just want to mention here is, just because SEEK has done well over the past 5 years does not guarantee it will be successful over the next 5 years. One of the ways I judge that is whether the share price performance can be attributable to financial expansion, multiple expansion, or a combination of the two. And when you look at SEEK, just like ARB, there's been a lot of multiple expansion happening with this company, which means the market is willing to pay more of a premium for the shares, the company shares right now, than it was 5 years ago. And whenever you see that, there is increased risk of underperformance for the company's shares over the next period of time. So keep that in the back of your mind, that just because this company has performed well over the past 5 years doesn't mean it'll perform well over the next 5 years. Now to another company that I actually have held in the past. So in fact, a lot of these companies I have held for periods of time. SEEK, M&F Group, JB HiFi. I bought that at $8, sold it at $16. So definitely I should have held on to those shares. REA Group was a long-term hold for me from about 2012 to 2021. So I recently sold that. And Commonwealth Bank I've held in the past. In fact, Commonwealth Bank was my first purchase way back over 10 years ago. M&F Group was my net phone, changed the name to M&F Group. This is a classic growth story, particularly about 7 or 8 years ago. This company was releasing Appendix 4Cs, slowly increasing the cash receipts quarter on quarter, became operating cash flow, and continued succeeding. But we have seen the share price struggle over the past 5 years. Now, the share price has increased from $4.75 to $7.36, which is a capital gain of 55%. Not a lot of dividends, only 37 cents of dividends in that time. So total gain for M&F Group is right on 63%, tracking higher than the overall market or the STW. But again, we'd prefer to see total gains to be about 100% for an investable company, in my opinion. But we'll give this a slight pass mark. And we have seen a share price really increase over the past 9 months, going from $4.20 to $7.40. So the heavy lifting for M&F Group have been during 2021, because if we go from 2017 to the start of 2021, share price just went sideways. We have seen some peaks and troughs, but really underperforming during that period, and really only been the last 9 months where we've seen some good capital gains in the M&F Group. Again, I think people would see maybe the last 5 years underperformance for M&F Group compared to a lot of other companies in this list of 9. But again, just because you've seen this company underperform over the past 5 years doesn't mean it would underperform over the next 5 years. And that's the question we all have to ask ourselves. How is M&F Group going to perform over the next 5 years? It could become the best performing company out of these 9, and it's done fairly well over or since the start of this year, and maybe the trend will continue. When I did look at their financial state, we've seen slight improvement over the past 5 years, but nothing too exciting. So at this point in time, I do have M&F on my watch list, but I would like to see better financial performance from the company. Now, to the only company that I'm not really going to talk about, and that's TPG, simply because they went through this transformation towards the middle of 2020. And whenever I try to find any sort of share price history for this company before they made this transformation, there was nothing. So this is the share price or the chart for TPG since June, July of 2020. So I decided, instead of spending a bit of time trying to find information about TPG back in 2017, I thought I'd just leave this off the video and talk about the other 9 companies. Next company I want to talk about is Magellan Financial Group. This company has been a substantial success story, both financially and share price, for a lot of retail investors over the past decade, maybe even longer. We have seen share price appreciate quite considerably, but as a fund manager gets larger and larger, they can struggle to maintain their returns they give their shareholders. And I think Magellan Financial Group has been seeing some of that happen to the company over the past few years, and we have seen the share price and the financial performance of this company struggle over the past 2 years. That's why you see the share price move into a well-defined downtrend. In fact, it has decreased from a high of $74 to a current share price of $34. So it has halved over the past 2 years. Now, if we do look at the 5-year returns for Magellan, share price has increased from $24 to a share price of $34.38. That's a nice capital gain of 43%. If we include the dividends, total gains are at 78%. That's sort of in between the STW at 50% and sort of returns I would like at 100%. So I would give Magellan Financial Group a pass mark for Tom Richardson and the Motley Fool, and that total gain would have been significantly higher if the share price remained near its highs at $74. At this point in time, I do have Magellan on a watch list. I'm paying it quite close attention to the movements in the share price, because if the share price can or does move significantly lower from where it is now, I think this will become a good value play. Next company, Reliance Worldwide Corporation, is a company I do like, but I've never held this company. I've thought about taking a position. In fact, the last time I really thought about taking a position was a few weeks ago, about 3 or 4 weeks ago, when the share price went under $5, and that was a short-term low, and the share price has really taken off over the past few weeks. In fact, the share price has increased from $5 to a current share price of $6.40, and it's moved to an all-time high, which has beaten the previous all-time high, which was made way back in the middle of 2018. Reliance Worldwide Corporation did list on the ASX in 2016, and on the 3rd of January 2017, share price was $3.15. It almost has doubled. In fact, the share price has increased from $3.15 to $6.14, which is a capital gain of $2.99 or 95%. Now, these sort of growth companies, you don't expect much of a dividend, so dividend yields wouldn't be that high. And that's definitely true for Reliance. Dividends of only 41 cents during the last 5 years, so total gains are at $3.40 or 108%, and that is greater than 100% return, greater than double the market return. So Reliance Worldwide Corporation was a good selection by Tom Richardson, particularly because we have seen a share price rise by about triple over the past 2 years from the COVID-19 financial panic lows, when the share price went down as low as $1.60, which means it's quadrupled, not tripled. So good momentum behind the company's shares right now, good positive sentiment, good financial performance as well. So a lot of things going right for this company, and I do think there is potential we might see this company's performance continue in the next 5 years like it has in the previous 5 years. So definitely, if you haven't done any research on this company, I would recommend looking into a Reliance Worldwide Corporation. I still have this company on my watch list, and looking back, I definitely should have taken a position when the share price went below $5 in the last 3 or 4 weeks ago. The final pick for Tom Richardson and the Motley Fool was almost the best performing company over the past 5 years, and that was realestatecom.au. This, at one point in time, was the longest held company in my portfolio. I bought this company way back in 2012 and then sold 9 years later on valuation reasons. Selling out a company just because it looks really expensive can be the wrong reason to sell out a company, because realestatecom always looks really expensive. But this company has performed really well over the past 5 years. Share price has increased from $56 to just shy of $164. That's a capital gain of 192%. When you include the dividends, and companies like realestatecom will have fairly low dividend yield, but it does make a slight difference. So it's increased the capital or total gains from 192% to 202%, just shy of ARB. I'd probably call realestatecom a better quality company, slightly over ARB, but just because a company is a better quality company doesn't mean it will outperform lower quality companies. There's all these other factors you have to take into account as well, and a perfectly looking chart for realestatecom, going from the bottom left to the top right. Now, in saying all that, saying really good performance, 202% capital total gains over the past 5 years, looking at the chart, and just because this has happened for this company over the past 5 years doesn't mean this will continue over the next 5 years. I think this is a very important point, which is why I'm saying it again. Past performance does not guarantee future success. We have to figure out if this sort of performance can continue over the next 5 years. I think there is potential, but my main concern right now with realestatecom is just the valuation. We have seen a bit of multiple expansion happening with this company over the last few years, and whenever I see multiple expansion happening, that does fill me with a little bit of concern, because that can mean that future financial or future share price performance can underperform the market. Overall, did Tom Richardson and Motley Fool do a good job? And the way I classify whether they did a good job at stock picking is whether the overall returns are at least double the market returns. If I see that, they did a great job, and they should maintain being stock pickers and not put their money into ETFs. And if you add up all the total returns for these 9 companies, we get a percentage return of 109.6%, well in excess of double the overall returns of the STW. So looks like Tom Richardson or Motley Fool, however they decided, these 9 companies or 10 companies did a very good job at stock picking. That is all I have for this video, looking at the stock picking performance of Tom Richardson via the Motley Fool. I'm not sure if Tom Richardson is still working, applying his trade with the Motley Fool, but based off his stock picking success from this article, he did a really good job. Total returns at about 110% compared to the STW, which is at 50%. That's exactly the sort of performance you want to have if you are a stock picker, just like Tom Richardson might be, just like I am. So congratulations to Tom Richardson. Congratulations to the Motley Fool. You did a good job, in my opinion. If you have any questions about this video, any other companies I featured in this video, or any other companies on the ASX, just leave your questions, your thoughts, your opinions in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. See you later. Bye.